Hello, and welcome to Trusts and Estates Weekly. I'm your host, Kevin Bemmel, standing again. And we are here every Monday at 10 a.m. Pacific time, 1 p.m. Eastern time, and that makes it noon Central time and 11 a.m. in the Mountain Zone. And I'll have to let those of you who are not in the continental United States figure out your own adjustments. It's too much for me. I can't even tell you what Greenwich Mean Time would be at this point. In any event, thank you very much for joining me. We're here for a half an hour each week to talk about various matters concerned with handling trust and estate matters and how to get business in that realm and do business with other practitioners in the whole probate and trust and estates arena. So one of the things that I learned over the last several years deals with the two basic different kinds of trusts. And it's interesting because just this little bit of knowledge really helped me much better understand what I'm faced with and why different trusts seem to be the way they were organized. So traditionally, when a married couple sets up a trust in which they put their assets so as to avoid probate, they'll have, I don't think you heard this term so much anymore, an inter vivos trust, what is a living trust, a revocable living trust. Whereas other times you'll see that things are set up as a irrevocable trust. So my daughter, for example, has an irrevocable trust that was set up for her by her grandmother. And there are very specific reasons why one may be used over the other. So let me start out by saying, as I often do, none of this is legal advice. None of this should be taken as this is what you should do. First of all, I am not a lawyer, so I am not professionally competent to tell you what kind of trust you need to form. That's a discussion you need to have with your lawyer and accountant based on your own specific situation. So, and that's true of everything we talk about here. All the professionals that I have on, the different concepts that we discuss, the broad advice that's given. You can't just take that and run with it unless you are very knowledgeable yourself. Now, of course, if you're a lawyer yourself or you're an accountant, so look, you're presumably competent to make those decisions on your own. But for most of us, lay people, as I call us, right? We're not lawyers and accountants. We're not intimately familiar with all the vagaries of the law, of tax law, of accounting requirements, et cetera. These are not decisions, generally speaking, that we want to make without having gotten proper advice from our professionals. And in fact, for those of you who saw my show last Wednesday on people making money, we were talking about financial literacy. And part of financial literacy is understanding when we need to reach out to other professionals to get their input so that we can make sure that we're doing the right thing with respect to our finances, and so that our efforts to build wealth will work as well as possible. Okay. Now, that's not to say sometimes things are going to happen. We're going to make an investment decision that doesn't pan out. We're going to make a decision about how we structure something, and then soon after that, the situation may change, and that may turn out to have been, in retrospect, not the best path for us to have taken. That's what happens in life. I one of my philosophies that I attempt to live by is we can only make the decisions. We can only make decisions that are as good as what we know about at the time we make the decision. And we don't want to either be paralyzed by never knowing enough, nor do we want to be hampered by making decisions that are ill-advised because we didn't reach out to the proper professionals. in order to get their advice. And so we want to hit that middle ground there, and accepting that in the end, we're human. And so mistakes are going to happen, and we're going to have to proceed on that basis and do our best to recover from those mistakes. Hopefully they're not so devastating that they, knock us out of the game and all that kind of stuff. So we're going to talk today about two types of trusts, revocable and irrevocable trusts. And I have my, handy dandy PowerPoint. Here we go. And slideshow. Okay, fade from start. So here we are, Trusts and Estates Weekly. That's our show. And let's see. So, I realized I didn't put in my whole thing about the 3 pillars of attainment. So you can see it here in the background. Everything we do relates to the 3 pillars of attainment. We're dealing primarily in the pursuits pillar, in the finances realm. But you're going to see that when you are talking about types of trusts, one of the key, what am I doing here? There we go. One of the key issues to take into account is relationships. Okay, and so that's going to play into this as well. Okay, so there we go. All right, so there's 2 types of trusts. As I mentioned, there's a revocable trust and an irrevocable trust. Okay, now I'm sure there are others, but for our purposes, probably most of the trust situations that we're going to deal with are going to be one of these 2. All right, so let's talk first of all about a revocable trust. Now, one of the key features of a revocable trust is it's flexible, okay? In other words, it's revocable. So you can transfer assets, you can set up a revocable trust, you can transfer assets to it, and if you want to down the line, you can revoke the trust and pull the assets back out and distribute them. Okay, the trust, it sort of has a life of its own, but you're in control of that life. Okay, now and this is why I think that for a married couple, typically the living trusts they set up are revocable. Unfortunately, marriages are marriages are often revoked, if you will, right? There's dissolution of marriage here in California, or divorce in states where there has to be, some sort of precipitating event for the marriage to be dissolved. And so couples need the ability to revoke the trust, disperse the assets based on the terms of the divorce, and then move on their way, and in many cases probably create another revocable trust, depending on what their assets are, how burdensome probate is in their state, and their personal situation, et cetera, et cetera. Okay, so a revocable trust has that aspect of being flexible. It is now, with a revocable trust, it's taxable to the grantor or grantors if there's more than one. So if it's a wrong thing. So if it's a married couple, so then there's going to be 2 grantors, and the transactions within the trust won't file its own tax return. The grantors will, in essence, what happens as a result of transactions will pass through to the grantors, and they will deal with the tax consequences. So, for example, let's say over the past tax year, which would be a calendar year, most likely, the trust generated dividend and interest income of $10,000. Okay, and it also generated long-term capital gains income of $10,000. Okay, so if the trust is a family living trust where the husband and wife are the grantors, and let's to make it simple, let's just say they file their tax return jointly. So on their joint personal tax return, they will report the $10,000 in dividends and interest on their tax return, most likely as investment income, and they will report the $10,000 in long-term capital gains as a long-term capital gain on their personal tax return. Now, if they're married filing separately, so then that's a more complex situation. And now here's where you need to get your accountant involved. Do they split the income 50-50? Is it split according to the percentage of whose assets were transferred to the trust? All of that, would have to be worked out. But the main concept to grasp here is that the trust does not file its own tax return. It pays no taxes. All of the activities in the trust that have any kind of tax consequences are passed through to the grantor or grantors, okay, not the beneficiaries, okay? So a trust, as you recall from a previous show we did, and if you want to go back and view that show, please go to our YouTube channel. I talk about some of the basics. So a trust has at least one grantor, that's the person who sets up the trust. It has at least one trustee, that's the person who manages the affairs of the trust. And it has at least one beneficiary, and that's the person who benefits from the trust at some point. So for a married couple, it would be somewhat typical, for example, for their children to be the beneficiaries, okay? With a revocable trust, the children, the beneficiaries, there's no tax consequences with respect to what happens in the trust until the grantors die, okay? And that's a typical case where a married couple would set up a trust, is so that their assets can be passed along to the beneficiaries without having to go through probate. So once that process has taken place and the trust has dispersed its assets to the beneficiaries, so now the beneficiaries own those assets. The trust doesn't any longer, and so now they'll be responsible for any tax consequences as a result of owning that property. Okay, but even when the grantors die, okay, a final tax return, a final personal tax return has to be filed for those grantors. And it will include whatever transactions or tax events happen with the trust property. It'll be included in that final personal tax return. Okay, so while the trust is in existence, the beneficiaries don't have any tax consequences to be concerned about, nor does the trust itself. It all passes through to the grantor. Okay, now here's a key thing though about a revocable trust. When the grantor dies, it becomes irrevocable. Okay, so at that point, it can't be dissolved. Okay, so when the parent, to use the example I was using a minute before, once the grantors, the husband and wife of a trust die, now the trust can no longer be revoked. Okay, prior to them both dying, it can be, okay, and in fact, the terms of the trust can be revised. You'll do it may be a restatement of the terms. There's different, lawyers have their own language, and for good reason, in order to be as clear as possible about what's happening. I'm not going to get into that. However, once the grantors, now if there's one grantor, once he dies, that's it. The trust is now irrevocable. Okay, but if there's more than one, once the last grantor dies, now the trust has become irrevocable. Okay, now that doesn't change what happens tax-wise. Okay, so the taxable events of the trust will still pass through to the grantor's personal tax return. It's just that the terms of the trust can no longer be changed. So trustees and beneficiaries do not have the authority to change the terms of even a revocable trust. Okay, the grantors do, but then once they're deceased, that's it. That's why it becomes irrevocable, because the parties that had the authority to change the terms of the trust are now dead. And so it becomes, in fact, irrevocable. Okay, so those are the key aspects of a revocable trust. There's others, but I don't want to make this, super, super complicated. These are the ones to have a working knowledge of as you're building up, your ability to deal with trusts and estates, as you're thinking about questions to ask your lawyer, your accountant, in terms of your own finances. Okay, these are the things to keep in mind. Okay, so that is the revocable trust. Okay, so the irrevocable trust. Okay, so again, I mentioned my daughter has an irrevocable trust. Okay, so once it was set up, her grandmother, who was the one who, I mean, she didn't literally set it up, right? She had a lawyer do it. And actually, I think probably her husband did it, for her, dealt with the lawyers and such. But whatever. She was the grantor. Okay. Once it was set up, that was it. Okay. It could not be revoked. She couldn't say, "Oh, I'm so mad at my granddaughter. I'm taking that money away from her." But couldn't do it. The only way to change an irrevocable trust is to get court approval and also approval of the beneficiaries. Okay. So just like with a revocable trust, an irrevocable trust has at least three parties, at least one grantor, at least one trustee, and at least one beneficiary. Now, by the way, it's not unusual for the grantor and the trustee to be the same person, although not always. Okay, so it just depends on what the grantor wants. But notice here, the trustee's approval is not necessary. The trustee is essentially a manager. So if there is a compelling need to change some aspect of an irrevocable trust, the trustee is probably going to be the party who goes to court representing the trust in order to explain to the court why the term needs to be changed. Okay. But keep in mind that the trustee cannot do this unilaterally. It requires the beneficiary's approval. Now, if the beneficiary is a minor, so then I'm sure there's more complications that come out of that, because as a minor, the beneficiary doesn't really have standing. And so, all of that would have to be worked out. You can see pretty quickly why it's necessary to have good legal advice, good accounting advice. Even as a trustee and a knowledgeable trustee, okay, you're going to want to be careful about all of these issues and make sure that you're proceeding correctly. As many years as I've been dealing with these things, I would never just, go to court, on my own sort of authority as a trustee and petition the court to change the term of a trust without consulting with competent legal counsel, without considering the tax and other accounting consequences of that change. All of that needs to be taken into account, even by people very experienced in being a trustee and dealing with trust matters. Okay, so that's the key, and that's where the sort of irrevocable comes in. Okay, now, by the way, with a court order and the beneficiary's approval, in theory, the trust could be revoked. Okay, but that's pretty unusual. Off the top of my head, I couldn't come up with a compelling circumstance where that would be, where that would be something that the court would entertain. Although I'm sure they're out there. I don't want to take your time to puzzle over it. All right. So next is an irrevocable trust is the less common form of the two. Okay, so in general, the trusts you're going to deal with will probably be revocable trusts. Okay. And that's because of the flexibility, right? So you can see this is a much less flexible arrangement. And so for people to do this, they've got to be very sure about what their objectives are before they create the trust. So it's just going to happen less often. Generally speaking, when we're making financial decisions, having flexibility is a good thing. Okay, but there are situations where there is, flexibility is not as important as other issues. Okay, now next on an irrevocable trust. So an irrevocable trust becomes a separate taxable estate. It's essentially like a separate person. Okay, so when you think about corporations, right? There's two types of corporations. Well, two general types of corporations. Okay, there's a C corp and there's an S corp. Okay, with an S corporation, the investors get the protection of the corporation, protecting them from liability. But financially, what happens financially, the corporation is passed through to the owners of the corporation. Okay, so the corporation itself is it's not a separate taxable estate. But with a C corporation, and we're all familiar with C corporations, even though we don't know it. Almost every big company we deal with, whether it's AT&T, whether it's Walmart, those are C corporations. Okay, so the corporation itself is a separate legal person, and a tax return is filed by the corporation. Okay, and whatever the corporation does, it is responsible for the tax consequences of that. Okay, and then as far as the investors are concerned, just like with the S corp, they have the liability protection of a corporation. However, their benefit in being a shareholder is they get dividends. Okay, now there are other financial benefits they may get, but generally speaking, they're going to be paid dividends. Okay, and in fact, the profits of that corporation typically will be taxed twice. You may have heard of the double taxation of corporations. That applies to a C corp, where the C corp pays taxes on its profit first, and then when it distributes some of that profit to its shareholders in the form of dividends, they will pay taxes on those dividends as well. Okay, so with an irrevocable trust, it's kind of like that C corp in the sense that it's a separate taxable entity and it needs to file its own tax return generally. Now, again, this is not something that if you're not really knowledgeable about trusts, you want to do on your own. This is something you want to get legal and accounting advice about. Okay. So first of all, the tax rate for trusts, very different than the personal tax rates. Okay. And you can see, by the way, below here, it's kind of, hopefully you can read it. It's in kind of small type. So right now, there's a federal tax exemption of almost $13 million for individuals and $26 million for married couples. Okay. So what that means is, how the whole tax regime of trusts work is very complex, okay? Because it also ties in with gift tax laws. There are lifetime exemptions. These exemptions here are lifetime exemptions, and so how much of them have been used up, how much can still be applied to the trust. All of that has to be taken into account. It's not like, going on TurboTax, and doing your personal income taxes. Okay, I don't even know if I don't think TurboTax I don't think it has a trust function in it. I don't think it has a corporation one either, by the way. C corp one. In any event, okay. the trust, a separate trust, has to file its own tax return on the taxable events that happen with respect to the property held by the trust. Okay, so you can see that there's a level of management in a trust, if you're a trustee, that is more complex than with a revocable trust. So if you're an accountant, for example, you're going to have more to do for a taxpayer or client, I should say, who is let's say a grantor or a trustee of a irrevocable trust than you might for someone who has a revocable trust. Because with a revocable trust, you're not going to be preparing a tax return for that trust. You're just going to be saying, you'll be asked, okay, what kind of income does the trust have? Did it sell any assets? What are the results of those sales? Did it buy any assets, right? And you'll be collecting the same information about the trust that you would about your taxpayer, and it'll all go together in one tax return. So you may have more information, but there'll still be only one tax return. Whereas for a client who has an irrevocable trust somehow involved in their finances, so you're going to have a whole separate set of tax issues and accounting issues to deal with for that trust, as if it were its own person, as well as the private the personal tax return, I should say, of the client. Now, if let's say you're in the real estate business, there's a big difference between selling a property for I shouldn't say a big difference, but there may be a difference to selling a property for an irrevocable trust versus a revocable trust. In any event, if you're going to be dealing with property held by a trust, you have to make sure that the people you're dealing with have the authority to be engaging you to manage to help manage the trust's assets. So whether you're a property manager, whether you're a broker, whether you're a mortgage broker, whether you're an appraiser, okay, when you're dealing with property held by a trust, just because someone calls you up and says, hey, will you do this? They may not have the authority, or at least the authority, to bind the trust to pay you, okay, and to have you act on behalf of the trust. Now, someone may call you up and say, I'm disputing something about a trust and I need an appraisal for it, but I'm not the trustee. I'm not a beneficiary. I was, and I got kicked out, or so, whatever it is. So that's not to say that you cannot do the specific piece of work the person is asking you to, but you need to be careful about who exactly is employing you and what authorities they have and all of that, okay? So all of that needs to be checked out before you proceed with the engagement. Okay. So which is better? Just real quickly, because we're running short on time here. These are just some questions. I can't tell you which is better. Like I said in the beginning, it depends on your specific circumstances, and that's something you need to talk to your lawyer and accountant about. So are you looking to avoid probate? What is your situation with respect to federal estate tax? Do you want to retain control versus relinquish control, right? With a revocable trust, you're going to retain control. With an irrevocable trust, you're largely relinquishing control. Is your property going to change? Okay. And if so, do you need the flexibility in order to accommodate those changes? These are some of the questions you need to think about and discuss with your advisors before you make a decision about what kind of trust is appropriate for your situation. Okay, so as always, here's places you can go to get help, ask questions, make comments, good or bad. Tell me if I've gotten my, tongue over my eye teeth and couldn't see what I was saying correctly. Yes, that's as good as the humor gets, folks. So sorry about that. I'll blame it on my daughter. She says, no, Daddy, your dad humor is funny. It's like, I don't think so. But in any event, these links will be in the show notes after the show posts to our YouTube channel. And then we just have, the sort of legal stuff here. I'm going to go ahead and close out of this to wrap things up. So that's the show for today, talking about the differences between revocable and irrevocable trusts. I hope you enjoyed it. I hope you got something out of it, increased your knowledge. Of course, we could dive ever deeper into this, and I'm gonna be working to line up some guests so we can have lawyers and accountants talk about these things. I think that's better, because then you're getting it straight from the experts, especially when it comes down to that sort of real granular information. So I just want to remind you, tomorrow at 11 a.m. Pacific, 2 p.m. Eastern is my show Business Lessons from the Military, where we talk about doctrine, history, great leadership from the military, and how we can apply that to our business lives to make them go better. And then on Wednesday is my show, People Making Money. My guest this week is Brett Henderson. He's a financial services professional with Strategic Wealth. He also has a podcast dealing with veteran entrepreneurship. And so I'm looking forward to speaking to Brett, a new friend of mine. And then, of course, next week, it all happens again on the same schedule. So I hope you will join me often. And if you want to join the sessions live and interact with me live, ask questions, have discussions, feel free to go to my Eventbrite page. The link will be in the show notes, and you can get a free ticket. And otherwise, you can always tune in on the various social media to watch the live stream and see the recordings on our YouTube channel, youtube.com/@the-way-to-wow-show. So thank you very much for watching today. Looking forward to, we've got someone in the waiting room here at the end of the show, unfortunately. Looking forward to seeing you later this week, and wishing you a wonderful rest of the day and a terrific week. Take care. And Marie, darling, you are my belle. Take care, everyone.